BlackRock manages $15.3 trillion, but that money doesn't belong to BlackRock. Other people own it. So why does the company managing it matter so much to global finance? Here's what makes the story interesting. BlackRock started in 1988 as a bond shop. A handful of people, Larry Fink included, built the firm around one skill: understanding risk before it blows up a portfolio. That obsession with risk eventually became software. They called it Aladdin. Then, in 2009, BlackRock made a move that changed everything. It bought Barclays Global Investors, and with it, iShares. Suddenly, BlackRock wasn't just managing portfolios. It became one of the biggest players in ETFs. Instead of picking stocks one by one, investors could buy an entire market in a single trade. Cheaper investing, wider access, massive scale. And scale feeds itself. More assets, more fees, more products, more distribution, more assets. That's the machine. But here's where BlackRock gets really interesting. Aladdin, that risk software born from BlackRock's early obsession with portfolio risk, grew into a platform used by major financial institutions to analyze portfolios, markets, and risk. And BlackRock kept expanding: infrastructure, private credit, data, private markets, public markets, ETFs, technology, private markets, each layer stacked on the last. Now here's the misconception. People see BlackRock owns company X and assume BlackRock personally owns the company. But much of those shares are held through funds on behalf of clients, pensions, institutions, retirement savers, and ordinary investors. BlackRock manages that capital. It doesn't simply own it. So is BlackRock just an asset manager? That's the wrong question. The real story isn't that BlackRock owns the world's money. It's that it built an enormous system for managing, packaging, and analyzing it. And when you're sitting in the middle of that much capital, you don't need to own the money to become incredibly important to the system that moves it.